Hi all, it's Callum here at the DIY Investing Guide channel. Can I ask you all if you could subscribe to this channel, hit the like button to help the channel grow, and hit the notification bell just for future videos like this. This is going to be my second video in my watchlist series for YouTube. I did plan on doing this video a few weeks ago when we'll just put it on my watchlist, but I have actually built a position in this company over the last 2 or 3 weeks, and you'll see that in my first free trade portfolio update episode next week. The company is Alibaba, sticker symbol BABA. In this video I'm going to go through the story and a bit of research into it, a broad research. I'm not going to go into too much detail into the company. What its durable competitive advantages, the moat, as a lot of famous investors, I think it was coined by Warren Buffett, but the moat of the company is durable competitive advantage over the long term, what I think it is anyway. What my holdings are actually across all my portfolios and accounts, and I'm going to do a valuation. I'm going to show you my valuation on the company with its margin of safety price, and how I value out a company, my personal way of valuing a stock or a company. I just want to put out there, this is a disclaimer, I'm not a financial advisor. I'm not advising you to buy or sell any stocks. Please do your own research and seek advice where necessary. Everyone's personal circumstances is different, and I'm not telling you to invest your money. I'm just taking you on a journey and showing you how I invest and what I'm investing in. So do it yourself, DIY. First of all, I'm just going to go through a brief outline of the company, what the company does, and its history, and it's a bit of research into the company, but nothing too in depth or, I'm not going to put up charts and loads of analysis and stuff like that, but this is the basic outline of the company. Alibaba is a Chinese internet giant, and it provides an e-commerce platform, which is its main business, cloud computing, which is growing at a rapid pace, and digital media, and much more. It's like the Chinese equivalent of Amazon, basically. And I've actually got the app here open. If you look, I've downloaded the app for Alibaba, and it's very similar to Amazon. It's got a few different consumer electronics, your apparel, your wear, and you can just buy stuff on this platform like you would on Amazon. It's the biggest platform in China for it, and China's a growing consumer market with people coming out of poverty and stuff like that. So it's quite a useful app. It's quite a clean app. It's quite handy, quite easy to use. I haven't ordered anything off here yet, but it is very popular in China. You've got messengers, your cart, Alibaba, shopping carts, stuff like that. And obviously I'll go through a few subsidiaries. There's AliExpress, there's Alibaba.com, which I've just shown you. These are all the subsidiaries. It's got loads and loads of subsidiaries, smaller companies as part of the overall company. I think mainly Alibaba is one of the reasons that Amazon China didn't take off as well, because it is the main competitor for it in that country. Alibaba Cloud, Alibaba Pictures, all sorts of stuff, and a lot of these are growing companies within the larger company itself. So yeah, these are all Alipay, AliExpress, AliCloud, big ones. It's got its own ecosystem, very similar to Apple. And yeah, it's got a lot of subsidiaries. It has been hit with the £2.8 billion anti-competition in China. Basically, the Chinese government accused it of monopolising its industries, and it was fined 2.8 billion, which it's a lot of money, but compared to what the assets that Alibaba holds and its revenue and its profit, it's not, and its cash flows, it's not a massive hit. It could have been a lot worse. I'm just going to go through a bit of the history and the background of it as well. I'll just show you, look, if you look, this is the 7-day chart. It started the week at 223 and it rose to 244 after the news that Alibaba had been hit with the fine. So I think a lot of it was investors don't like being unsure. They like to know what's going on. And a lot of people thought it's a good company, good value, but they weren't willing to invest in it while they didn't know what was going on with this. And I think that the line's been drawn underneath this whole episode at the moment. So it's probably a good time to maybe look into invest in Alibaba, in my opinion, in my portfolio. So there you go. And it's pretty much done nothing the week then. It's just stayed where it is. I'll go through my valuation and what I think the company's worth a little later on. But if I just go to the 1 year graph, see it's gone to as high as 300, and then it's took a dip there, and then it's slowly recovering now. So that's where Alibaba is in terms of its price at the moment. And so let's go through the history in the background. Alibaba is the largest e-commerce worldwide, mainly in China, but China has got a massive population, hasn't it? And it's a growing consumer population, whereas the US and the UK and places are already established consumers, so that they're still growing. People are still spending more money year in, year out, but China's rapidly growing consumer, with more people coming out of poverty and being able to spend money on consumer items. I think a lot of it is, after £7,000 a year, people start to be consumers, or say pounds, each yen in China or whatever, the equivalent. But after a certain amount of income, people start to becoming consumers. But before that, it's just the bare essentials like bread, milk, food, sustenance, heat, water, shelter. And China is a growing population, and it's also a growing consumer country. It's a growing country at large. The whole economy it's growing at a rapid pace. I'm quite bullish on China myself. I'm going to go through the history in the background. So I've gone over it's one of the biggest, and it's biggest in China. It has tens of millions of daily active users, and its three main sites are Taobao, Tmall, and Alibaba.com. I hope I pronounced the other two right. The company was founded by Jack Ma in 1999. So let's just call him the Jeff Bezos of China. In 1999 or 1997, the late 90s, it was around that time when the dot-com bubble was forming. And he had a vision of the largest online and e-commerce company in the world, much like Jeff Bezos. And it was the best time to enter the market when consumer habits were adapting and shifting and familiarising with buying goods and services online. And I think it partnered with Yahoo.com in 2005, and it now runs the Chinese division of Yahoo Finance. Alibaba went public itself on the New York Stock Exchange in 2014, and it had a $25 billion IPO, and it took Wall Street by storm. This could have been. Now it could be. I think it could be the opportune time to invest in this online retailer, after it's just been hit with its anti-competition practices of 2.8 billion. And like I said earlier, it could have been worse. I'm just going to go quickly through the business model, a brief outline. It's not going to be detail or anything, and the durable competitive advantage and the moat now. Its business model and its durable competitive advantage. China is the world's biggest e-retail market. It's actually the biggest market for people spending online transactions. All payment methods, a majority of payment methods in China are through an online payment system, and a lot of their consumer products and services are brought online rather than physical stores. And it's the biggest in the world. So you say Amazon has grown to the size it is with the market it's got. Alibaba is the leader in the Chinese market, and the Chinese market is the biggest market for e-retail and e-commerce. And yeah, as I say, with Alibaba, the biggest platform in the country, online retail is becoming more competitive. This is more of a bare point, but Alibaba has a strong network and ecosystem that gives the company a wide competitive advantage, a wide moat, and a durable competitive advantage, in my opinion. With its digital commerce and cloud computing becoming more competitive, Alibaba will need to keep on investing in technology and its infrastructure and its logistical innovations to maintain its robust, durable competitive advantage. So it's got good cash flows, and it's got good income, and it's growing its revenues, and it's growing its profit year in, year out. So it will have the money to keep on continuously invest. As long as the management can deploy that capital in an effective way, that they should keep growing. They should keep this durable competitive advantage over the long term, in my personal opinion. I'm just going to go for a quick performance. In 2020, its revenue was 71.98 billion, and the company is very profitable. It's got a lot of assets and not a lot of liabilities. I think it's like 10% debt to its total assets, which is a good debt ratio. Its market cap is about 600 billion at the moment, but when you strip the assets, so say if it was a private company, you stripped all of its assets and sold them all off, it'd be worth about 500 billion. In the private markets, public markets always trade on a much higher multiple than the private markets. But as you can see, its market cap in the public markets is only 600 billion, whereas in the private markets, if you stripped it all, it'd be 500 billion. So that's quite cheap, isn't it, really, if you think about the multiples and stuff. And then you've got to look at its net cash operating income is about 15 billion in the first 9 months of 2021, well, their financial year, which makes this look even cheaper because it's got all this revenue coming in and profits and cash conversion. Its underlying assets are worth 500 billion, but its market cap's only about 600 billion. So that looks relatively cheap in that sense. The average annual revenue growth of Alibaba is between 20% and 30%, and it is set to continue for at least the next 5 years. So, you know, it's still got a lot of revenue growth between 20 and 30% for the next 5 years of a minimum. So that's good news. That's good, healthy growth. And you also compound the company's growth. So 20% or 30% on year one is another 20%. That's compounded as you would compound your own returns in your own portfolio. So it's not all about dividends sometimes or buybacks, share buybacks. Sometimes it's about, you know, how's the company using its capital and getting its return on capital and return on equity, and compounding that to increase your share and your holding in your own portfolio. And this is another thing. This is another bullish point. Charlie Munger. I'd already started a position in this, but I've just recently read, and this week it's been in the news a little bit, and a lot of YouTube videos about this. Charlie Munger, who historically only makes investments on rare occasion when the odds are overly in his favour, and he keeps a very concentrated portfolio of only between 3 and 4 stocks in his own personal portfolio, has made an investment through the fund he manages for the Daily Journal Corporation. Well, through the Daily Journal Corporation, really, he owns the Daily Journal Corporation, has made an investment totaling $37 million, which equates to 19% of the Daily Journal's equity portfolio. Now, historically, I don't think he's made a transaction in this portfolio since 2009. I know he invests in equities because rather than leave it in cash, because he thinks he'd get a better return on cash, but he'll only invest in certain companies when the odds are considerably in his favour. So that's a good bullish point for me, and the fact that he's willing to put 20% of that portfolio into this company around about its current levels is a good sign for the company. It's not a sure thing, you know. Even the best investors get it wrong sometimes, or pay too much for a company. And they'll both say, Charlie Munger and Warren Buffett will both say that they've made their fair share of mistakes. It's just when they've got it right, they've really got it right, and it's made up for them small number of mistakes. Well, they're not nothing's ever a mistake. You can't forecast the future. If we could all forecast the future and forecast interest rates, we'd all be millionaires, wouldn't we? Billionaires even. So that's basically the outline of the company, and I hope that gives you a better view of what Alibaba is. I know people in the UK as a consumer wouldn't know as much about Alibaba because our main use is Amazon, and it's a Chinese company. So I thought I'd give a brief outline and research into this company. There's a lot of people out there that saying they wish they'd invested in Amazon when it was at much lower prices. Well, Alibaba is a similar company, and it's at a decent price in my opinion. So yeah, I'm going to just quickly go through in a minute with you my valuation method on the company, and then I'm going to go through my holdings across all my accounts. So if you can bear with me, I'll go through that with you in a second. So here in this part, I'm going to be looking at how I evaluate a company and how I've done a valuation on Alibaba with the margin of safety price. I'm just going to say, like, obviously, all the prices and fundamentals of the company in this section are correct as of the time that I've made this particular slide. So obviously, as you can see, the price on here is $244 a share, whereas you've seen in the video at the current time making the video, the price of the stock was trading at $239 a share. So it's not all to the exact figure, it's just correct at the time that I've made this slide earlier in the week when I was doing a valuation on the company and trying to work out what a good price to buy into them. I'd already got a small position, but what a good price I thought would be a good price with a margin of safety in case anything, happens in the future with this company to give me a good rate of return over the next 10 years. Obviously, when you buy a company, you want to hold it forever, but obviously I've done this in a 10 year time horizon. So first of all, I'll just quickly go through how I've done this. I do the growth rates, and I normally do growth rates, just a flat growth rate for 1 to 10 years. But with Alibaba, 29% is quite a high growth rate, so I've just done a growth rate of 1 to 5 years at 29%. And then for the following 6 to 10 years, I've sort of halved that growth rate to about 15%. To just be a bit more conservative on the long-term outlook. The PE ratio over time of doing this was 27.84. I think it's about 29 now. And this is the latest EPS I got on the earnings per share for 2020. It was $7.90. That's how much every share for every share you have, how much profit it's producing. And it was $7.90 at the end of 2020. The MAR is my minimum rate of return. Now, on individual holdings, I like to make at least 15% a year. So that's the aim. I mean, if I make 10% a year, I'm not going to moan at that. My overall portfolio, if I make between 5 and 10% on average per year, I'd be happy with that with compound interest over the long term. But on individual stocks, I like to make about 15% a year. If you make 100% a year, you're laughing, but that's not the norm. But as a rule, I like to make 15% a year return because that roughly doubles your holding every 5 years. So let's just get cracking into it. I've used this calculation to work out what my 10-year EPS will be, so I can work out what the 10-year share price will be. And then obviously I've done the 5-year EPS with the growth rate, and then I've done the 10-year EPS with the growth rate. And after 10 years, based on the current growth and the projection, these are just projections, by the way, they're estimates and projections, they're not guaranteed. I've worked it out that the EPS will be around about $56, $57 in 10 years' time. So then calculating that, I've kept the PE ratio where it is about now. It could be higher, it could be 50, it could be 60, but I've been conservative and I've kept the current PE ratio. So I've times the 10-year EPS by the current PE ratio, and that gives me a price of $1,580 for the 10-year share price. And that's not guaranteed, that's just where I think it would be in terms of value if it was valued at this current multiple of 27.84 on its current growth projections. So, working back from that, with a 15% return, I've worked out, if I wanted a 15% return, you have to divide it by 4, because obviously 15% roughly doubles your money every 5 years. So 10 years, I've had to divide it by 4. And that gives me a current value, not what the price is, a current value of $395, because obviously price is what you pay, value is what you get. Warren Buffett, Charlie Munger, that's what they say. So the current value, I've got it at round about £395, dollars and 5 pence. I keep on saying pounds, I'm from the UK, I do apologise, but it's $395.05. But obviously for a margin of safety, because things can happen, the government could get involved with the company, it could have a bumpy road, it could have not quite hit its growth projections, it could have revenue down, COVID-19, financial crises, they come around, you don't know when they're going to come. So that's why I've done a margin of safety price, so that is 50% of the current value. So I've divided the current value by 2, which gives me a margin of safety price of $197.53. So roughly about $200 a share. So obviously the share price at the time of this post was $244, and it's now $239. So, and I've got the current value at about $395. So really, my buy range would be anything between $200 and $280. I probably wouldn't pay anything over $280, but so I'd say that in my personal opinion, for my portfolio, I'd be happy to pay $244 for this share. I'd probably be willing to buy more at the lower end of the 200s and less when it gets closer to 280, but I won't spend any more than $280 at current valuations on this stock. If it dropped to $180 like I did earlier in the year and the end of 2020, I'd probably load the truck up and try and get as much in as possible. I'm willing myself to go to about 20% of my portfolio in this stock if the price did go down to a really low valuation like $200, $180, providing that it wasn't for a reason like, there wasn't a reason that was going to affect the overall story and the business operations. I'd be willing to go up to about 20% of my portfolio. So that's my valuation of the stock. And that's where I'm happy to buy in at prices. It's not a recommendation to buy or sell the company. This is where I've worked out my valuation and where I'm happy to average into this stock. I'm just going to go through my holding at the point of this post. This was my holding in Alibaba. It might be a bit lower now. It might be a bit higher. Obviously, the share price has gone down to $239 a share, and obviously the pound has increased in value against the dollar. So that currency, there is a currency issue when the pound increases in value to the dollar. Because we hold it in pounds, your holding actually decreases slightly. But over the long term, I don't invest because of what the currency is doing. I invest in companies that I know are going to grow in the long term. Well, I have an educated guess and think they're going to grow in the long term. So here's my holding. I've got £1,844.43 of a holding in Alibaba Group, which is roughly about 8% of my portfolio. That is 10.439 shares, because obviously I've got some in my Freetrade account, I've got some in my main portfolio, and I can buy fractional shares in my Freetrade account. The gain loss at the time of this post was minus 22.72. That was mainly dealing charges and a little bit of currency. Obviously, what I spoke about, the currency going up and down. It's cost me £1,867.15 to buy these shares and have this holding in Alibaba, and my average purchase price in pounds was £178.85, and the share price when I've done this post was £242.98. So I hope that gives you an insight into where I am with Alibaba. Obviously, I've put my money where my mouth is. I'm not just doing a video saying, I like this stock, I think this is a good stock. I've actually invested into this stock, as you can see. And you obviously see more holdings in this stock and how they're going in my free trade portfolio update, which I'll be doing episode 1 in the next week, and my Hargraves Lansdowne ISA portfolio updates, which I'll be doing later on this week as well, or early next week. I've already done preview videos on both portfolios. If you'd like to go and check them videos out, the link will be in the description. The link will be in the end of this video. I'd just like to say thanks for watching. I hope you've enjoyed this video. Can you give it a like to help the channel grow? Subscribe to the channel for future videos, and hit the notification bell so that you can get notified when there's a new video uploaded to the channel. I hope you've all enjoyed it. Have a good day.